Hi everyone, welcome back to Corporate Decoder, the place where we turn boring corporate filings into something you might actually want to watch. Today we are diving into Wintrust Financial Corporation's latest filing. Get ready for preferred stock, depository shares, and maybe, just maybe, we'll figure out what any of that actually means. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so come chat with us. Wintrust just announced they're selling a whole bunch of something called depository shares to raise around $14 million. They might use that money to pay off some older shares or just invest it. Let's dig into the details to see what's really going on. First off, Wintrust Financial Corporation is the company we are looking at. They're based in Illinois, and you can see their file number and tax ID right here. Nothing too exciting, but good to know the basics. This report is an 8K, which means it's a current report about something important that just happened. In this case, it's dated May 8, 2025, so this is pretty fresh news. Okay, now we're getting to the heart of it. Under item 1.01, which is about entering into a significant agreement, we learn that Wintrust is making a deal with a group of underwriters, basically banks, to sell these depository shares. They are offering 17 million depository shares. Each of these shares represents a tiny fraction, a 1,000th of interest in something called Series F-preferred stock. Think of it like owning a very small piece of a special type of stock. This Series F preferred stock has a liquidation preference of $25,000 per share, which translates to 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 20 goes belly up preferred shareholders get in line before common stockholders. The agreement they have with the banks, called the underwriting agreement, includes promises and guarantees from both sides. Wintrust promises they are being honest about their business, and the banks promise to do their best to sell the shares. There's also some legal protection in there, where Wintrust agrees to cover the banks if they get sued because of this deal. This is pretty standard stuff in these kinds of agreements. This whole thing is happening under something called a shelf registration statement, which is basically a pre-approval from the SEC to sell shares when they want. They are using a prospectus supplement from May 8, 22-25, and sale is expected to close around May 22-25. The sale is expected to close around May 22, 2020. 2000s in, everything goes smoothly. So after all the fees and expenses, Wintrust expects to get about $414.7 million from this offering. That's a lot of money, so what are they planning to do with it? Here is the real kicker. Wintrust says they will use the money for general corporate purposes. That's a pretty broad term. It could mean almost anything, but they specifically mentioned that they might use the cash to buy back some of their older preferred stock, Series D and Series E, but they need to get the Federal Reserve approval for that. In the meantime, they might just stick the money in cash or short-term investments. Basically, they are keeping their options open. It also turns out that some of the banks helping them sell these shares are also lenders to Wintrust. This isn't necessarily a bad thing, but it is something to be aware of. It's like your friend recommending a mechanic who also happens to be your friend's cousin. There's a connection there. One of the banks will also be the registrar and depository for the shares. If you want to read the whole agreement, it's included as an exhibit in this filing. It's a long, complicated document, but it has all the legal details. Now, what does all of this really mean? Wintrust is raising a significant amount of money, potentially to clean up their balance sheet by redeeming older, possibly more expensive preferred stock. This could make them look better to investors. The fact that they are keeping their options open suggests they may not have a clear plan yet, or they are waiting for the right opportunity. The connections between Wintrust and the banks involved in the deal are something to keep in mind, but they seem to be pretty standard in the financial world. Overall, this filing suggests that Wintrust is making strategic moves to manage its capital and potentially improve its financial position. Whether it will work out remains to be seen. I wouldn't say its direction is particularly strong or weak, but it definitely seems like a competent move. It's basically a way to make the company's financial structure a little more efficient. One risk to keep in mind is if the Federal Reserve does in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.